Welcome, everyone. I'm Chris Gessel, Executive Editor of Investors Business Daily, and with me today is Mike Webster, a Portfolio Manager with O'Neill Data Systems, our sister company. And today we're going to be talking to you about everything you need to know about trading IPOs. And we've got a lot to cover. Let's jump to the agenda. And really, I think by the end of this webinar, you will have much more information than you probably currently have on the right way to find, buy, hold, and then ultimately sell IPOs and really have a good strategy to put to work. We will also take a look at the current stock market, which is anything happening there, Mike?
No, nothing at all. It's been a slow week.
Slow week, right. And then we'll also take a look at some current IPOs to see what might be setting up, especially in a market like this. So, but before we start with that, I want to give a few moments to our sponsor, and that's Simpler Options. And we have John Carter, the president of Simpler Options, with us today. Simpler Options is a great educational resource, and John knows a lot about IBD and CanSlim, and they also work a lot with IPOs and their option strategies. So let me pass this off to John for just a few moments.
Well, Chris, first of all, thank you very much. I've been a fan of Investors Business Daily since as long as I can remember. I took my first stock trading class in the early 90s. It was a CanSlim class. I actually did the master's class again in November of 2013. I saw Mike there in Los Angeles, and so it's just, to me, in terms of finding stocks to trade, IBD is essentially my go-to resource. So just real quick about me, and then we'll get on to the IPOs. We can look at the book. I have been doing this since the late 80s, and although I do like to trade stocks and buy stocks, my niche, my forte is options trading. I love the leverage that's involved. I've written about my own trading experience and everything in a book called Mastering the Trade. This is something that can be found on Amazon. If we go on, we can, in terms of the whole idea of IPOs, and a lot of times people think of IPOs and they may not think that, is this something that either they don't understand IPOs, which is going to be great because Chris and Mike are going to talk about how to trade them, but worse, they don't understand the power of being able to use options on IPOs, okay? And in terms of options, I mean, not all IPOs are priced to have options right away. The ones like Facebook, Twitter, the big names, they will have options very quickly. And the good news is that those options typically come out and are available to trade when there is an initial base being built in the IPO. One of the things that you're going to hear about tonight is the power of these IPO bases and how these bases are actually more powerful than any other kind of stock that they are. What I like to do is take advantage of all the pros and cons of options with this. So the idea here is that the problem a lot of people don't realize with options on IPOs is that when the options come out, they're very overpriced. So you have to time them very specifically. If you don't, it may not work out well. Also, the premium portion of an option in an IPO can fall very quickly. Well, that's something that you can use to your advantage as well if you know how to do it. And the best thing about options on IPOs is that you can use options to lock in your gains, and you can hold on to stocks that are running and not worry about overnight risk. All right? So that's what I have about IPOs. We have put together a quick class for you guys. If you are interested in learning more about how to trade options on IPOs, we can take a look at this next slide here and just see that we put together this course. It's normally a course that we've done before. It's like a $500 course. You can check it out for just $7. If you go to simpleroptions.com/IPO, you will be able to see essentially all the strategies that I'm going to be using on IPOs that are coming out this year and next year, essentially using and coordinating that with the setups that I follow in IBD. So it's just a leveraged way to play IPOs, okay? That's what I got. Chris, I will hand this back to you and Mike, and I'm looking forward to your presentation. And thank you again for having me.
Great. Thanks very much, John. All right. Well, let's proceed. And really, the the overall question is, why trade IPOs? A lot of people, with their experience, IPOs can be very volatile. There's lack of price history, at least in the way that we typically want to look for stocks setting up in bases and with a prior uptrend and things like that. Most people, at least with the initial pricing of the IPO, can't get in on the first day and get that pop. So I guess, Mike, what's the overarching benefits of trading these stocks?
Well, I think the best way to answer that is really look at a few charts. And our first one is Home Depot. All these charts I took out of our model books that we have around the firm that both of us look at all the time. And in going through the model books, and that's how Bill wrote his book and started the newspaper, just studying models and looking at huge moves and then tracing it back to the beginning. Anyone who spends some time going through these model books, you'll notice a number of stocks that go public, just go have a short little consolidation, then have a massive run, like this Home Depot. You can see the tiny little base there, and then an enormous run, 1,700% in just a little bit of time. Then we have Apollo in the mid-90s, very similar to the Home Depot from the 80s, where you went public, you didn't have to buy in, you didn't have to get the shares from the underwriter. You have to wait for a base to form. It's a tiny little base, breaks out in almost up 1,000%. In a short period of time. And then a little bit slower mover here is MasterCard, not that long ago. And this broke out of an IPO base and ended up having over a 200% move in about a year. So it was a very nice move, well contained.
You call that slow. I think a lot of people would be very happy to be up 200%.
Yeah, we all would, but on a relative basis. Good point, Chris. Now here's a crazy one. Here's Solar City. Story name, story stock, and again, very similar. It just has a nice little consolidation and has a very rapid advance. In 20 weeks, you're up over 200%. So even if you don't capture that entire move, if you capture, half or the bulk of it, you've made a lot of money. So that's what really got us interested in studying IPOs. Is we saw this through all the model books. And Charles Harris and I did a model book going back to the 1880s. And they're even, scattered through that time frame too. So that's really what got us interested in studying them, is the huge move that we have. And here's just some of the model books that we're always playing with.
Yep, I got them at my desk.
Yes, you do. Yeah. So what happened is, after we were going through these, we really wanted to study all the bases out there and see, what really makes a base tick, what makes a good base and a bad base. So we've been undergoing this, massive project over the last few years because we've been able to harness the pattern recognition technology. So rather than us, playing through a few books here, we were actually able to harness the database that we have here now with the pattern recognition technology and putting this IPO base in there and study all the bases and see really what makes a good base, what makes a bad base, and then answer a lot of questions that we had.
And that's the pattern recognition that people who take MarketSmith and get that upgrade.
Yeah, absolutely the same thing.
Logic.
Yeah, I'm sure a lot of people listening today probably use the pattern rec in our MarketSmith tool, and it's great. I wouldn't trade without using it. And so we've been able to use that and go back, and the power there is we've studied every stock from 1962 to now, every base, even stocks that have merged, gone out of business. We have the data, and we've studied it, and now we're at a point where we're going to release some of this information. The first piece we're releasing today is what is the very best base, and that's what one of the first things we got out of the study was, and what you're looking at here is all of our standard bases, and then you can see the IPO over on the right-hand side, and that just jumps out at you. And what you're seeing is all of the bases in all of time that broke out over $10. And what we did is we said, let's compare the apples with apples. So we took the stocks that broke out in 1962, saw how far they went, when they ultimately talked, and we said, okay, that's that. Those are the stocks from 62. And then we did the same thing for 63 and so on. Because if you don't do it that way, you can be skewed by really big years like the late 90s or really bad years like the 08, 09 timeframe. So this is apples to apples. And I said a model book move is really your top 5% for any 1 year. Now, we haven't been able to put the fundamentals or the story or the industry group in this data yet. So this is just technical. So just imagine you now know that the IPO base is far superior to any other base. So that's what you're going to want to spend your time, and that's what we're talking about today, and we're dedicating a lot of our resources here at the firm.
So just to clarify, what that's saying is the top 5% of stocks on the left side, it's not saying that they went up by an average of 15%. It's saying that 15% of the biggest stocks that year first broke out of an IPO base.
Yeah, exactly. And so it's just telling you relative to all the other bases. We always thought all bases were kind of created equal for the most part, and you can see, the cups with handles and cups are about the same, but the IPOs jump out well ahead of everything else. But do keep in mind, it's a smaller sample size because you can have, dozens of cups with handles over the years in a stock, but you can only have one IPO base.
Right.
So,
but even that actually makes it work in its favor if you want to think about how really powerful it is, because there's only, it can only have one, and you might have a cup with handle at the beginning of a run in many times over in a stock. So that's, to me, that makes it even more powerful.
Yeah, absolutely.
Well, this research that you've been doing has, all the charts that you're seeing today are part of a home study that Mike has been working on along with the education department, Jonathan Howard and Eric and Bridget, putting together, and it's really powerful research that we've been using over the last few months, especially on Leaderboard. It really has helped us find some good IPOs and trade them properly, even in a market like this where it's been kind of tough to nail down some of the gains. But anyhow, let's begin with the characteristics of an IPO base.
Yeah, again, to answer that question is really looking at a chart, and this is Google. This is the classic IPO base, and really the whole study of IPOs came about after the firm kind of we all piled into Google separately, and Bill bought it, I bought it, Charles, Scott, all the portfolio managers around here were all buying it at the same time, and we weren't talking to each other. We just were instinctually looking at this. We knew the story, we knew the fundamentals, and we didn't have a base identified at the time, but we knew, this is something our eyes have seen because we've been going through the model books. So we all bought it, and we were able to capitalize on it. But afterwards, we went back and said, you know what, we want to make sure that we're able to identify the next one. And so I sat through and I went through every IPO of all time, and I walked away with, seeing that, boy, a lot of these go straight down. But the ones that work, they all have this thing in common. They have this nice little IPO base, so let's identify it. So that's what we have here. If you want to know what an IPO base looks like, look at Google. It's exactly like this. So it goes public, runs up just a little bit, and then runs into some resistance. That resistance will happen right away, within 25 days or 5 weeks, depending on how you want to look at it. This is a weekly chart that we're looking at. So within the first 5 weeks, it's going to run into some resistance. Then it's going to back away and start forming a base. And you can look at this base. It's extremely short, shorter than any other base that we've ever looked at. And in fact, they can be, they're typically 2 weeks to 4 weeks long, and they're very shallow, generally less than 20%. We do have some examples. There's always exceptions that can be as deep as 50%, some in the late 90s even deeper than 50%, but you really want to look for the ones that have a shallow base structure. And so the depth should be 20%. We really like them in the 10 to 15% if we can get it. So
And the ideal length of an IPO base is, you're saying 2 to 4 weeks?
2 to 4 weeks is is typical. The key is that your left side high should happen within the first 25 days. That's what you're looking for, and that's what kind of separates it out. If it were to form a base after that amount of time, we just classify it as a different type of base. So here we've got Google. Let's take a look at it on a daily chart, and you can see this is the ideal way a stock should go public. You have an initial pop on your first day, so it priced out at $85, and before you know it's trading in the $100 range. And you'd like to see a prior uptrend. So we have 3 days of a prior uptrend, and then we hit 113.5 or thereabouts, and we start backing away. And you want to study how it backs away. Is there still demand there? The stock can come down, but you want to see, is it doing it in an orderly fashion? Does it look like it's being accumulated? And it certainly does. And one way you can tell is it stops right around $100 there and kind of goes back and forth for a little bit. There's some dead time, which is helpful, but it doesn't go below the low of the first day. So that's important. If you're looking at a weekly chart, you don't like it to go below the first week there. And then you have some power going up the right side of the base, and eventually goes through 113.5. That's where we were buying it. On that day, there's a little bit of a flaw that it backs away on that day, but it's no chart is perfect. But later on that week, we get some follow through, and by Friday you're over 117. So that's what we like to see, some power that comes in afterwards.
Now I'm seeing that the RS line is shooting to a new high. Is that fairly common?
In a lot of them, it will happen. What you want to keep in mind, and we go over, all the different ratings that we have within the home study. We talk about how some of them can be skewed because you're dealing with a short period of time. So looking at this chart, you just have a matter of a few weeks. So you want to take it with a grain of salt. So I like to see it going into new high ground there, but you want to look at the general market and see what the conditions were. So all of our ratings are going to be skewed in different ways because you're not dealing with a lot of data, just dealing with a short period.
So maybe the shape of the RS line is more important than the relative strength rating.
Yes, and the context of what, I would look at the S&P and the NASDAQ and any key days, like the day that you went into resistance or your bottom day or your pivot day, and see what was going on in the market. And in general, we want to see something that's outperforming, and as you said, that RS line going into new high ground. So we're back on a weekly chart, and what you can see here is that if you didn't buy it while it was going through 113, you really missed this stock, because if you were waiting for a pullback, you didn't get it. It goes up 70% in just a couple months before it starts backing away. And what's interesting about this, and you can really tell what an institutional quality stock this was, is each week you don't undercut the prior week. So that's everyone in there with those big orders, the big hedge funds, big mutual funds, with hundreds of thousands, millions of shares that they're buying, and that stock's just not coming down, not for a while. So it eventually forms a couple bases there. You can see if you would have bought the first cup with handle, there's nothing wrong. It's all bases aren't going to work out. If it breaks out, fails, you just sell it at 7%, or once you realize it's failing, and it forms another cup, and it breaks out. And look at each one of those weeks there as it's breaking out of that second cup that has a nice advance. Same thing like our first advance. Each week is holding up above the low. You don't have any fresh lows. So that's very nice. And if you bought that around 113, before you know it, it's a $400 stock. So they're not all that easy, Chris.
Right.
Yeah. But that is the model. So if you're having any trouble with this, I know that we're going to be I think we're going to record this, and people can play it back, and they can look at the Google example.
Yeah, so everyone who's registered will be sent a link of this webinar.
That's right, yeah.
And of course, it'll be available on the website as well. All right, so we talked about the basics of the base. Let's go into a little more detail of when is the right time to buy.
Okay. Again, I think you know how I answer questions is with pictures. Yeah, with pictures. So here is our poster child for when not to buy an IPO, and it's Facebook. And I love Facebook. I use it. My daughter's finally on it. Everybody I know is on it, and Chris, you're not on it.
Yeah.
You're the only. Okay, so there's one person in the world, so they still have growth. Okay, I think the earnings line is going to turn up next quarter. I'm going to get you on. So this is an example of a company that goes public with so much hype. You remember all the hype that was around this, and everyone who knew that what I did for a living was asking me, are you buying Facebook? And I said, I'm going to wait for a base. And I went home that day that it went public feeling so silly, just saying, this is the time I should break the rule and just buy this stock. It's going to be a $100 stock in a blink of an eye. But I didn't. I waited. And you know what? It was a great company, great product, perfect management, but the stock just wasn't ready for whatever reason. So the key takeaway from this entire webinar, if you don't remember anything else, remember this Facebook example, is all IPOs should not be bought. You have to wait for a base to form and break out. And so it doesn't form a base, so you cannot trade that. You can't trade it until it forms a base, forms a really deep cup with handle, tries to break out and fails, and forms that really, I think it's an ugly double bottom, but it really worked from there, and the key was that massive volume that finally came in. So that is not an IPO base, it's a double bottom. It didn't happen anywhere near its public offering. So, but again, the key is no matter how much you love the product, don't just rush out and buy it once it goes public. Wait for it to set up. And let's take a look at another name that everyone knows, LinkedIn. Now you're on LinkedIn, right? You're on LinkedIn. Okay. So you know this one. I'm sure a lot of people out there, use LinkedIn or at least are aware of it. And so again, it was a very hot stock. You can tell that it went public at $45, and it had a pop of over 100% on the first day of trading. And so that's an enormous amount of demand on the initial day. But you can see that first week it backs away and it can't even close in the upper half. So that's a sign that you've got a problem. And then look how it comes down. It comes down, and we've got a depth of greater than 50%. And that's in a market. You can look up on top there. You can see the S&P 500 during that base building time. It's really, it's in, a little bit of some trouble there, but it's not a free fall at that point. So a base that's over 50% deep while the market is just going down a little bit, that's too severe, and it's V-shaped. So these are a bunch of things that are problems with it. But the easy thing is it never breaks out. Your pivot is as it goes into new high ground, and it never breaks out of that. So two ways you can avoid it. Wait for the base and wait for it to actually break out. So that was Facebook and LinkedIn. Now we have some examples of some that actually broke out. And this is Michael Kors. This was, just back in 2012, and this is kind of a classic looking IPO as we know now. You can see what's great about it is that initial run up. It goes public at $20, and then it starts pricing at $24. So we've got a a little bit over a 20% bump, which is nice. You want the people that have the shares at the IPO price to be profitable on it. Those, they're less likely to just bail on those shares. They're more likely to be adding to it. So that's what you like to see. So it's running up, goes sideways, just very, very short, and has a really nice, powerful breakout. And you can see a little tiny gap there, and that's what you'd like to see, a big spread on your breakout. Unlike what Google did, this is the way you'd like a stock to break out on the pivot day as it goes into new high ground. And then it followed up the rest of the week. You can see, by the end of the week, each day, that powerful move was continuing.
Yeah, I wish I had your research at that time, because we were looking at this for leaderboard and debating, is this an IPO base? It seems too short. Mm-hmm. We had always used Google as the kind of the shortest that we should really be looking at, which was 3 weeks. And but I guess really 2 weeks is okay. And what's the shortest one?
Well, the way we have the pattern rec program design is right now is for 10 days, because for the most part, it should be at least 10 days. Now, we have a few examples, and we have them in the home study where they're shorter than that. Sometimes as short as 7 days, but really, that's really on the rare side. 10 days is going to get the vast, vast majority of them. And so with with the Michael Kors, that ran up, and it wasn't a monster move like the Home Depot or the Apollo or even the Solar City we were looking at, but still it's a very, very sizable gain in a short period of time. And I really thought the stock was going to keep running, and what do you think the problem was?
Michael Kors.
Yep. If you dump enough of your stock, the stock's going to go down. But the bottom line is, if you just would have let your 10-week be your guide there, and as long as it was holding above that, and then you sold when it went through that, and we'll circle back to the sell rules in a little bit, that you would have had a very nice gain in a very short period of time. So let's look at our next one. Hold on a sec. And this is Kohl's back in 92, and you can see it looks very much like the Michael Kors that we were just looking at. You have the prices out, it has a nice little run up, it goes sideways, and again, the key here is looking at that follow-on for the rest of the week. You really want to see that stock continuing to have power as it goes through the pivot, and you can see this had a very nice well-contained move, and if you look at that red line on there, which is a 10-week moving average, it's in a nice uptrend, and if you just let that be your guide, you have a very, very big move, and it's relatively easy to hold.
So let's move to when to sell these IPOs, and are the rules basically the same as they are for other canceling stocks, or is there something special?
There's a little bit special, but the cardinal rule that Bill came up with, decades ago of 7%, that doesn't change.
Right.
You never want to let a stock get down more than 7%. If that happens, there was something wrong. Maybe the market's just not right. But we'll get back to that at the end. So here is Netflix. This is back in 2002, and this is a name that I think everyone knows by now. I was using it in the first few years that they came out, and I was getting the DVDs back in 98 or 99, and I've been a subscriber for since then. And are you using this product?
Absolutely, all the time.
And it's great. My kids love it. It's a great service, very low price. So there's no reason not to have it. And so something like that comes public, and you just think, oh geez, I've got to buy this breakout. So you do. Now there are a few flaws with this space, but not enough that I wouldn't buy. But let's just point them out. The price is out at 15. You have a nice little gap up. That's good. But then you come down and you test it the first time. Within about a week, you come all the way back down to the IPO price. That is not ideal. You want to hold up above that price, but at least it stopped there, bounces up, and then the next time it just crashes through. That is really, really bad. And we don't see that in a lot of the models that work out. We have some, and we have a few later on, at least one that will show that it goes under the IPO price and then goes higher. But as a general rule, you want that stock to hold above that price because, all the people that got their shares before it went public, that's their cost basis, and you want them to have a profitable trade. So that was your first sign. Then it comes up and it breaks out. I would buy it as it goes into new high ground there. Would you buy it?
Yeah.
Okay. So everyone listening, would you buy it? Okay. The answer is yes. So then what happens? Within 2 days, you're down 7%, so you have to exit the trade. And that's going to happen with IPOs, just like any other base. And I want people to be aware of that. Just because having an IPO base puts odds in your favor, it doesn't mean they're all going to work out, and you have to manage your risk. So you exit that trade, with a loss. You could probably even sell it the next day because it's not down 7% on that second day, but it's telling you it should be sold. And before you know it, that's a single-digit stock. Now here's another one. This is 1-800-Flowers back in 99. And we were joking around the other day that, I think this is the only .com that didn't go up several 100%, right? And so here it tries to break out and immediately fails on that day. So that's going to happen too. And if that happens, you just have to be nimble enough to exit. If the stock can't hold as it goes into new high ground and backs away and you're down like that, exit the trade again. You can see that the IPO price was $21. And on that first day of trading, it didn't even hold. So that was certainly a warning sign. Now, something a little bit more recent, here's Twitter. You use Twitter, right?
Professionally.
Yeah? Okay. I'll send you a tweet. I'm not on Twitter yet, so maybe I should get on. That's why it's not working out. Once I get on, I'll turn around.
All right.
So here you have, again, some mixed signals there. It has a big gap on the first day of trading, but by the end of that week, it closes in the lower half. But that can be forgiven. It holds in tight there, doesn't give up a lot of that pop from your IPO. That's okay. Then it breaks out, and it's a solid breakout. Goes, nice move on that week. So I buy that stock, and a few weeks later, it's up and it has some stalling action. And some people might be selling into that. We're going to talk in a little bit about some hold rules. So we would actually be holding through that, but you never, another rule that Bill has, you asked me, are all the rules the same? The rule that he has in his book is never let a big winner turn into a loser. So if that's up like that and it comes in, you have to, no matter how much you like maybe their management or their product, you need to exit that trade. Something's going wrong. So I think you have a way that you were telling me.
Yeah, when I'm faced with a possible round trip, I like to get out, a half point or a point above my buy price, just so I can walk away with a little something in profit. It's always, tough when you give up a 10 or 15% gain, and it's even worse when that turns into a loss.
Yeah,
just from a psychological point of view.
Absolutely. I mean, I do the same thing, and for the same reason. Psychologically, if you've got a 20% gain that turns into a 3% loss, you're not a happy camper.
So, cutting losses is easy, at least, excuse me, theoretically. But how do you hold these IPOs to go for the real big profits?
Yeah. So what we've done is we've studied, we've gone through and let the computer do the work, the hard work for us. The way I approach the computer is I am just very open, and I don't say, I want an 8-week rule. I say, when do we actually sell this? Do we sell it at 4 weeks? Do we sell it at 20 weeks? So I let the computer go through and say, where's that optimal point that you should sell these IPOs? And it turned out to be 8 weeks, which is very funny because, before Chris and I were even, thought of by our parents, Bill came up with this rule that, if a stock goes up 20% within 3 weeks, you're going to hold it for 8 weeks. So here, this computer that hasn't ever talked to Bill, came up with the same thing. So it's a little bit different than his rule of 8 weeks. This just says it's an IPO base, so the odds are on our side, and that stock breaks out the way we like it to break out, like we saw with the Michael Kors and the Kohl's. And after 2 or 3 weeks, you're still up above that pivot. So you haven't round tripped. You're still up 5 or 10% on that. It doesn't have to be up the full 20%. And then you want to hold it for 8 weeks. And so you want to give this stock some room. Don't sit and look at the intraday chart. Don't look at the daily chart. That will scare you. And I'm my own worst enemy with that. Looking at every last little tick doesn't help anymore. And so you really just want to let that time be your guide, and we're going to show you some examples on why that is. So the next thing is, after that 8 weeks, you're really kind of on your own. You've got a choice. You have to look at it. That's where you have to analyze the stock and say, do I want to lock in all these gains, or do part of them or none of them? And we're going to walk through some examples there. And there's not really a wrong answer. It depends on how you want to play it. So I like to look at the chart, look at the fundamentals at that point. The stock has more history. All the ratings are going to be relevant and working properly at that time. And then assess it and say, I want to try to hold on for more. And what do you do as far as holding on for more? Well, you have a very simple rule. If you decide whatever shares you don't sell at 8 weeks, you're going to hold on until that stock decisively breaks its 10-week line. So let's look at a few of those examples. And of course, if somehow that stock comes back into the pivot area without breaking the 10-week line, which is probably almost impossible, you want to go ahead and sell it because, as we talked about, you don't want a big profit to turn into a loss.
And when you talk about a decisive break, it's a little different than maybe some of the other rules that we look at regarding the 10-week. There's not necessarily a volume requirement. It could break that 10-week in maybe average volume or slightly above average.
I'm not looking, for this particular rule, I'm not looking at volume at all.
Okay.
And we let the computer go through and do it. And one of the reasons for that is just think about this. The stock could be holding up all through Friday, through the entire week, and then all of a sudden on Friday, there's some news that comes out midday and the stock just falls, but the volume doesn't catch up yet for the week. So, we've just seen enough of these examples where the price action's there, the stock has been running for a long period of time, and it breaks decisively, not just pierces through. You want to wait for, that whole week to go. You want to wait until Friday. So that's we're not looking at intraday bars. We're not looking at daily bars. We're looking at a weekly chart and waiting for Friday to happen. And throughout this home study, we have tons of examples of all the different ways that they can break through it. So this first one we have here is a more recent one. This is Shake Shack. And so this is something that, if you were using this method, you would have bought in as it was breaking out of this IPO, what I call is IPO family type of base. And that is any base where your left side high happens within that first 25 days. So even if it's longer than your ordinary, 2 to 4 weeks of your typical IPO base, we're going to call that in the IPO family, and we're going to treat it the same. So you can see the Shake Shack breaks out, has a huge run, and then on the 8th week, you have to, decide what you're going to do. So, looking at this, the enormous run that it had, and it kind of had an inside week and then another week that's just, there's not a whole lot of conviction there. So I'd probably, sell part of it, but not all of it. It's, it's all in the news, and I think there were a lot of shorts in there, but still the stock is running up, and so you want to be objective about it and say, if I bought this at the pivot and I've made it through that 8th week, what am I going to do? And I'd sell some, but not all of the shares, and then just wait and see if the stock can make it higher. But it doesn't, and in in just a little bit of time, it decisively breaks that 10-week moving average. So that's when, if you hadn't sold any on your 8th week, you'd have to sell the balance there. Any thoughts on the Shake Shack? Were you guys all over that one?
I think that I don't quite recall, and I think that we were looking more at the fundamentals, and maybe it didn't make it on the fundamentals, or there might have been an issue with dollar volume, because that's another thing that we have to deal with.
Yeah, of course. And I've never eaten there, so that was one thing against it. So our next one we have is NXPI, and we wanted to include this one in here because it is an example where when it went public at $14, it did dip underneath that, actually quite a bit. And again, this is in the IPO family of bases. So you can look at it as a consolidation or a cup with handle or however you want to look at it. But basically, it went public, and within right away, it hits a high and backs away from there. So as it goes into new high ground there, that's your pivot, and you're going to use the same rule. So at 8 weeks, your decision is, do I want to sell part, all, or any of them? And what would you do, Chris?
Something like this, where it's come out and it, looks like it was up, 6 out of the 8 weeks, maybe 7 out of the 8 weeks, holds above the 10-week, I'd be holding it there at that point. It also looks like the market was doing fine as well.
Yeah, I totally agree. It's doing nothing wrong. So everyone listening, just, be honest with yourself. Ask, that question, what would you do? And there's really not a wrong answer. Both of us would hold it and then just wait for a decisive break. And you can see there, inter-week there on that blue reversal week, it does undercut the 10-week line, and that's why you're going to want to wait until Friday. And unless it's really excessive, and again, in the home study, we kind of deal with that, and we have some examples there. But if it really gets carried away on the downside, and if that happens on a Monday or Tuesday, you don't have to sit around for Friday. But stocks are going to pierce their 10-week line and test it. So our next one here is Under Armour. And again, this is a product that, I know a lot of people use. Do you have any of their stuff? Do you guys buy any Under Armour stuff?
I usually go to Target and get the Champion brand.
I have an Under Armour hat. Does that count? But so it broke out here, and again, it had mixed signals there on that IPO. You have an IPO at $13, huge gain on that first week, almost 100%. But then you back away, and you're closing, near the lows for that week. That's not a good sign. But the rest of the base was pretty much okay, and it breaks out as a solid breakout. But by that 8th week, you decisively break that 10-week line. So as Chris was, giving that advice that, if you've got a nice gain in something, just bring your stop up to when you're selling it, you're still up 1% or something like that. Even 0.25% is going to make you put a smile on your face, But
maybe not a smile, but at least you won't be kicking yourself.
Yeah, you won't be jumping off the building, right? So that's going to happen, and that's why we wanted to include these in here, because they're not all the Home Depots, they're not all the Apollos, and if you know how to handle it and you know what to expect, you can make a ton of money trading these IPOs. So let's take a look at one that we kind of started off with, and this is MasterCard. You can see there's an alternative pivot in there. Again, that's something that we go over through the home study, but it's fine using the standard pivot as it goes into new high ground and breaks out, solid breakout, and very much like the Google we were looking at, where each week it just kind of inches up without undercutting your lows. That's a sign that institutions are in there, and that's one of the things Bill taught me years ago, that look for that inching up. I think he used that, and it was AutoZone recently, maybe just a few years back, that helped them out. And so at 8 weeks, what are you going to do with that?
That looks fine. I mean, they're all up. Doesn't even look, maybe the 8th week, the low cut the prior week, but other than that, I mean, that's an easy stock to hold.
Yeah, it's beautiful. So this is the one that you don't look at it on an intraday basis. You turn it off. And if you see me looking at one of these, come in and turn off my monitor for me.
I'd have to turn off like 18 monitors.
Only 8. Only 8.
Okay, sorry.
So the stock continues up, and then look, what happens once it finally breaks, the 10-week line in a decisive manner. We were talking about this. You had a point about that.
Right. Yeah. I mean, the whole personality of the stock changed. Before, it was very easy to hold. If it broke the 10-day intra-week, it was closing above it, and those were, just minor blips there kind of midway through that run. And then after that, it becomes wide and loose, and it's dropping to its 200-day or 40-week. If you're trying to buy the breakout, it round trips you and comes back down. So the stock has completely changed. The easy gains are over.
Yeah.
It's a lot better to get out there and now look for something else that's fresh.
Exactly, and that character changing is something that we talk about at Chart School all the time, and it's when you look at a stock and it starts behaving in a different way, and we're going to talk about that when we get to the general market. When the behavior changes, you have to wait to see what that new behavior is. It could be better, or in this case, it could be worse, and that would be very difficult to make money in that after that point, unless you're just swing trading.
Right. Yeah. I don't think there's any way someone with a concentrated position could sit through those swings.
Yeah, I agree. And not that there's anything wrong with swing trading. It's just a different way of doing things. So now we're on our last one.
And where we started, Home Depot.
Yeah. So this is why we're studying this. So back in the early 80s, this was happening, and this is a stock Bill talks about in tons of the seminars over the years, and one of his favorites to talk about. And look, if you use this IPO method to get in right away, you would have an enormous gain. And look, it finally does break that 10-week. And earlier you were asking me, off before we were doing this, what's decisive?
Yeah,
that's decisive.
That's decisive. No doubt.
Yeah.
And the thing also to note, after it's made, how much is that percentage from the breakout to that initial top?
Technically, it's a lot.
Okay. Many thousands of
many thousands of percent.
So at that point,
it was 1,753.
Okay, so just 1.7 in your thousands of percent. Still pretty good. After that point, this stock corrected as much as 66% over the next year or two. And so this is a great example of the easy gains, which were huge, were over, and then it became much harder to hold. And it wasn't until maybe later in the 80s that you had a good area in which to buy it again and resume the uptrend.
Exactly, and that's why Bill's taught us to not fall in love with the stock. They're all great as long as they're going up.
All right. Well, let's move to the next section, and that is let's talk about what's been happening in the stock market overall and the broad averages, as well as maybe a few IPOs, even in this market, that are worth keeping an eye on. So first thing is, here's the NASDAQ, and this is coming off of Leaderboard and our ETF strategy chart. Back in early July, the NASDAQ made a new high, and finally breaking above that area that had held it since March of 2000. And then we started getting distribution like we have for the last 2 years. The market kind of pokes into new high ground and then gets turned back. So by July 24th, we were under pressure. And that's that first big break coming down to the red 50-day line there. And we kind of went back and forth and really until things started really falling apart, the distribution days on the NASDAQ were not too bad. I think before, as of last Wednesday, I think we had 5 distribution days on the NASDAQ.
Yeah, it was really the S&P.
Yeah, the S&P was looking worse, but the NASDAQ was actually doing better. Then on Thursday of last week, we had the big sell-off down to the 200-day. And, we debated that long and hard within the market team that day. And our thinking was, well, it looks bad, but we've seen this a lot in the last 2 years where we've had these sell-offs that come down to the 200-day, and that's usually about the time that they get traction and turn around. Another thing that happened, the put-call ratio spiked well above 1.15, another indicator that's been nearly bulletproof for the last few years. And I know that people inside the company have been using that to kind of swing trade and run back in the market. Bill has been a big user of that indicator as well. So, we didn't want to simply call a correction right where so many times before the market had turned around and started rising, but when the sell-off persisted on Friday and really gained momentum, that was like, okay, we get it. This is
you have no
this
choice.
has changed. It's like a character change. We had gotten support at these levels before. Now it's crashing through it, and that's where we put the market into correction. Of course, Monday was a wild day, at least in recent memory. As it turned out that decline intraday on the NASDAQ was only 9th on the all-time list. So 8.8 only gets you 8.8% only gets you number 9 these days. Some of the other big ones happened I think the biggest one was in 2000, and again, that was near the beginning of the bear market. We're not saying we're necessarily going into a major bear market. I think there's a lot of reasons to think that we could be in for a 20 or 30% correction, but things like rampant margin and just there just isn't the feel of wildness in the stock market that we've seen at other major tops that turn into big nasty bear markets. So then Tuesday looked like the market's been down a number of days, and you're expecting a rebound, and we were getting that, and then going into the close, that completely fell apart. What did you think about the market yesterday?
I thought it was terrible. And your point about the character changing, I think is really key. for a while now, every distribution would pile up and the market would find a way to just move higher, and distribution would pile up. It would look scary, and it just gains some footing and go higher. It's been very frustrating. But now,
really, I think the reason for that has been the quantitative easing, the low interest rates, not just in the U.S., but around the world. And every time the market started showing some weakness, whether it was China or the EU or England coming in, cutting rates, using quantitative easing. And so there's really been, let's say, an exogenous variable in this market that we really hadn't seen in other periods.
Yeah. Well, at least we're not living in China, right? So, with that said, I try to not look at those outside forces and just kind of look purely at the chart. And it's hard to tune that stuff out that we're all aware of. But really, what I'm seeing here is that the character changed, and it seemed like on Monday that the computers had taken over, much like the flash crash. And I was looking at through all the S&P 500 stocks today and yesterday, and just crazy things happened that just shouldn't have happened. It reminded me of when Kramer was on CNBC, during the flash crash, and he's like, "This is just, this shouldn't be happening." And
right, when you're seeing big stocks down 15 or 20%,
didn't make any sense at all. So to me, that had to be computers shooting, because the big guys that control big amounts of money, big guys and girls, I just don't see them dumping stock like that at an open on a Monday. But who knows? One day we'll find out. But at this point, I'm looking at it just saying, that was very scary, and for the most part, it makes me want to just kind of get small, stay small, and stay away.
Yes. And I guess one last point. So given that on Monday the market closed in the upper half of the range, so we know from our market school rules that counts as a pink or red rally day, and today was had big strength near the close. So tomorrow, theoretically or possibly, we could get a follow through.
Without a doubt, and I would think it would be relatively easy, just percentage-wise, with these big moves that we've had, to get a percent, even 1.5%, and the volume was less today than it's been. So for the last couple of days, so I think it would be very easy for a follow through to come, and you have to be. The one thing that Bill has always told us is you have to just deal with the market that you're given and just have an open mind. And so if there's a follow through tomorrow, we'll look and see if there's something to be bought. And if there's something to be bought, and that I would consider nibbling. But in general, this is looking scary, and to me, it seems like something that's probably going to have to put in some time. But I try to just deal with what the market gives me.
Well, let's take a look at a couple other prior markets. And actually, before we do that, let's take a look at the Shanghai. And China has been really driving this sell-off, especially recently. And that market is down 45%. As much today. At the intraday low, it's 45% off its high. So that's what I would classify as a major bear market going on in China right now. Anytime you're over 40% or so, that's very serious.
Absolutely. And Charles Harris and I were looking at this chart last week, and we just both came to the conclusion, this stock, this market has to break open. I mean, it's just, we've seen this before, and to us, it looked a lot like what happened in 1998, because we discussed that at the market school seminars, and we have a slide of 1998. And here you can see, just like the Chinese market,
that's amazing how similar it is.
Yeah, it comes down. The ultimate low is 33% here versus the 45% that you said on for China. But you can see it comes down, comes up to the declining 50-day, and that's really something that Charles always taught me about it, as far as once you run into declining 50-day, you're probably going to back away, and back away sometimes in a big way. And we've studied this market a lot. Bill made a ton of money. The firm made a ton of money coming out off the second bottom, and that's when they bought, AOL and Schwab and a lot of other ones.
Right.
But to me, this looks very similar to what was going on in China, and you can see at the ultimate bottom is what we call heavy volume without further price progress on the downside. It's a mouthful to basically mean, people are starting to soak up shares. They're accumulating shares, and instead of going down a lot each day, you just go down a little bit and the volume picks up. Let's go backwards to that Chinese chart, and this is today. On today's action in China, or last night, the volume picked up, not as much as we saw in 1998, but you didn't go down as much. So the way I'm interpreting this is, China could be like 1998, and you could have, a double bottom here where we rip up, and that should bring the market, our market up if that happens. The good thing is we'll know right away. If you start undercutting this and continue lower, that precedent won't hold. But that's the most bullish case I could find for something out there. So again, here's 1998 on the NASDAQ, and then let's see what happens. We'll, a couple hours, and China will be open. We'll know.
So, and then let's take a look at 2011, because this is another example of when you have a big volatile break in the market where it just plunges over a week or two. It usually doesn't come right back. It takes some time, and we saw that in the summer of 2011, and it really wasn't until late December that we got a follow-through, and then really the beginning of January where it got traction and started moving, and that was a very profitable quarter in the market. If you're doing things right, you made a lot of money there.
Yeah, and that was when I've been looking out over the last few days. I've been looking at all the market charts, and this looks like what we're dealing with is, we're probably going to wake up tomorrow if the market's up 500 or down 500. It's not going to surprise me. So back and forth action like that, and you can just get chopped up in that and not make any money. But like you said, around the corner in December, then things firmed up, and that's when you can trade in a bigger way.
All right. The last thing that we need to do is let's go to a couple IPOs that are out in this market right now. And someone was asking, would you be buying an IPO when the market is in a correction?
No, you shouldn't really be buying any stocks until there is a follow-through date. Now, there are exceptions to everything, and we've seen, a few cases over the years. But in general, especially going with what we've had this week, if you don't get a follow-through date, you sit on your hands.
Right.
And if you're still holding stock, you look at those stocks and make sure that you really still want to hold them. So here's one that we have, and we were screening through trying to find some IPOs to talk about today, and there really aren't much out there. I got this out of the Growth 250, which is in MarketSmith.
There's a nice IPO sub-list that you can go to that and just we'll find all the recent new issues.
Yeah, and I think that's the best way. If you're gonna buy this home study and start using this method, I think that's the easiest way to do it, is use the Growth 250 and use the IPO or the first year little sub-list there. It'll make life a lot easier. Or you have something in the newspaper as well, I believe, for IPOs.
Right. Tuesdays and Thursdays we have IPO leaders, and that's a similar screen where we've made some exceptions. Like you said, not all the ratings are useful early on. Usually about the first 13 weeks, you have to look at things with give them some, give them some grace. And so we adjusted our screens, and really what we see is all the big IPOs that really have the good fundamentals will show up in that screen. I think the thing to note about NEOS is it broke out, and then it fell more than 7% from that early breakout. Now it's come back on. It's really showing great relative strength in this market. That RS line is just shooting through the roof, but maybe not the best time to be out there.
Yeah, like I said, I wouldn't be buying. This is even extended at this point, but it was some of the best that we could come up with when we were looking through to try to find something. That's telling about the market too. The IPOs work really well in a forgiving market, but not in what we've been just dealing with.
Okay. And then Blue Buffalo, a pet food maker, just came public a few weeks ago. This one, it could turn into something. Now, it's broken a few things. Has it undercut the IPO price?
Let's look here. It's hard to see on the screen. No, the IPO price is $20, so
Okay.
it's held up above that.
But it undercut the opening, the first day,
yeah.
in the first week. So that's a sign of weakness. But given what's happening in the market, you could, not penalize it too much. So right now it looks like it's, creating the left side of that initial consolidation.
And I keep an open mind and look at it might just completely dwindle and go down, or if it goes through the pivot there, new highs, I'm going to study it. And if we have a follow through, that's something that I would certainly consider. And I always go to the company's website, try to understand what they're doing before I buy anything.
All right. Well, with that, let us show you that the IPO home study, which Mike has worked so long on, and thankfully I got to help work on it and kind of got a sneak peek and learned a lot of the rules along the way, which was very helpful to us on Leaderboard. But this is available beginning today, and within the IPO home study, it's a large format book. It's got hundreds of pages and many examples, and we cover the model IPO base, IPOs without a base, IPOs that never break out, so you can avoid the IPOs that shouldn't be touched. What to do with round trips, looking at the ones with shorter moves, those with longer moves. There's also some technical factors that we didn't go in here that you can get off of MarketSmith that help judge whether an IPO is good. And of course, those management strategies and covering alternative buy points and more insight on the sell rules.
Yeah, it's very comprehensive, and I've never been more proud of something that we've put out. And I think the team has done a really good job with this, and even the presentation I think is beautiful.
I'm going to have to agree with you on that one. It also comes with DVDs. So there's 2 DVDs, 3 hours of audio where Mike is walking through many of the examples. How many charts do you think you covered in that?
I think it was over 120, something like that.
Yeah. So again, it's an oversized book, 11 by 17, and there's 125 annotated examples. So call the 800-831-2525 or go to investors.com, IPOHS for home study, IPO home study, and take advantage of that. And we also know that there's a lot of people online that may not be fully aware of IBD and what we do in our publications. And so we have a special offer for you folks. We've got 4 months of eIBD for only $40. That's one of our, if not our best introductory ever. It's got to be right up there. So again, call our toll-free number or go to investors.com, eIBD40, and learn about everything that we're doing in the paper each day. And like we said earlier, we do have a section on IPOs that shows up on Tuesdays and Thursdays, a really great screen that really focuses in on the top tier of the IPOs, and that's a great place to start your search.
Absolutely.
So I think we've gone well over our time limit today, so we did get a couple questions in there. We know that many people have been submitting questions, and we've been answering them. We've got people answering them as we go along, but we just want everyone to know if your question didn't get answered, we'll have a team going through all the questions, and we'll get back to you as soon as possible. And also, if you didn't take advantage of the chat feature on this webcast, you can always contact us via email at support@investors.com. That's support@investors.com, and we're happy to answer any questions for you. So with that, I want to thank everyone who made this happen. Kofi Appiah, next to us in here, did a great job getting this all together, and of course, Jonathan and his team, John Becker and the marketing team, and of course, Mike. I really appreciate all the work that you did in this, and that you shared it not only internally with us, because it's already made a big difference for us, especially on Leaderboard, but with all of our readers as well.
Great, thank you. Nice being here.
Okay.